morning, Armor Insiders, and an eventful morning we have. Thank you for joining me for our morning meeting. I hope you all had a good night and you're ready for whatever action we have today. Let's get right to the risk monitor, talk about how we've changed our portfolios, what are we doing with our whiteboard, and a little bit of philosophy after what happened yesterday. So diving in, virtual hedge fund, portfolio manager, that's you, CIO, we're getting ready for our trading session to manage our hedge fund together. Whatever I talk about, you got to figure out how that works for you. What's your risk tolerance goal? Execute it. You got to be the smart money. All right, let's there's so much to talk about yesterday. I think the easiest way to get started is to say the whistling has stopped and it's turned to screaming. And I've been saying to you for the last couple of weeks that equity markets can whistle past the graveyard of debt just so long. And then something happens that wakes up the equity players and you get yesterday, Exhibit A. So what happened? Chairman Powell, the chief vampire in the graveyard, rises and everyone starts screaming. He talks about cutting rates another 25 basis points, but then kind of admits that the Fed has no idea what's going to happen next year because of the incoming administration. And so they're putting their hands up going, we don't know. We have to kind of slow down and wait and see what's next. There's so many things for me to talk about what happened yesterday. I'm just going to kind of list them off for you. They might not be totally coherent. It was very hard to write the morning note for you. There's just so many things that happened all at once. Maybe the most disturbing thing, and there was a lot of disturbances, but maybe the most disturbing thing is the reaction in the bond market in the 2-year note. Now, we know the 7 to 10-year paper and the 30-year paper is more volatile and changes direction based on what bond players think the Fed's doing. So you can have short-term rates come down, long-term rates go up. That's not a terrible thing. It's steepening yield curve, whatever. But to have Treasury bill rates, which is 12 months and under, going down because the Fed's cutting rates, and the 2-year note, that's just like an extra month. You know what I mean? The 2-year note has rates going up as the Fed's cutting. I can't remember the last time I saw that. There's so many I can't remember the last times. Recently, as an example, market's down 13 days in a row. The Dow's down 13 days in a row. The equally weighted S&P is down 13 days in a row. 13 red candles. You got to go back to the 1970s to see the last time that happened on the Dow. I mean, I could go on all morning, but we don't have the time. There were so many anomalies that were building in the market. And I said to you, hey, I'm willing to keep executing. Risk monitor's green. I'm going to put some capital to work. We're going to focus on big cap. We're going to focus on our leaders. We're not going to add anything new, right? There was some discussion about adding things new yesterday before the Fed meeting. I think you see now why I never trade in front of the Fed meeting, ever. I get off the desk. I don't sit down until 1:30 just to help myself manage the desire to put money to work in the morning on a Fed day. Never do that. I would always rather pay up for an idea after we get past the Fed meeting and everything's okay. I don't mind. I'll pay a little bit higher. I'll pay a little more for Disney, but I'm not buying Disney strength first thing in the morning in front of a Fed meeting. You know that's an Armor axiom. If you weren't sure why I do it, now you see why. I care more about protecting my capital than capturing upside. That's just who I am. That's my risk tolerance. I want to make money, but first I got to protect it. So Chairman Powell starts speaking, and the most important thing he says is, we don't know what's going to happen next. 2-year yield is going up as he's cutting rates. At its basic core, you hear about bond vigilantes, which have been dead for years. I think they're rising from the graveyard now. What they're basically doing, when rates go up on bonds, whether it's corporate bonds or government bonds, I know there's a lot at play here, but let's simplify it. What are they really saying? The bond players are saying, we're not sure that this company or this country will be able to cover their debt payments out to this year. And so you have to pay us more to hold your debt, right? Isn't that the basic core of what's going on? So you see a corporate bond and the yield starts going up, the bond starts breaking down. It's because the bond players are saying, we're not sure this is a going concern. We think maybe 5 years from now, 10 years from now, this company will be out of business. So if you want us to hold your credit, you got to pay us more. That's the basic relationship. And so what really was disturbing to me yesterday was to watch the 2-year note go up The interest rates went up as the Fed's cutting. So what bond players were saying is, we don't know. We're not as convinced today as we were yesterday that the U.S. government can service its debt 2 years from now. That's what it's saying. Now, I'm not saying that the U.S. government's going to default on debt, but I'm just trying to simplify what's the argument of why 2-year notes go up, right? It's because the bond players are saying, you're going to have to pay us more to hold on to this debt because we don't know what's coming. What don't they know? You've got the Fed cutting rates, but you have a new administration coming in and the Fed saying, we don't know what we're going to do next because we don't know what Trump tariffs will do, Trump austerity will do, Trump tax cuts will do. Now, put your opinions about politics aside. I think those things are wonderful for my country. I think we need better trading partners. I think we need austerity. I think we have to cut a bunch of fat from the government. I think we need lower taxes for corporate tax rates. And we could debate that on another day. Okay. So I think that's all great for the country. But in year one of making that drastic change, the bond vigilantes are saying, you're going to have to pay us more to hold this debt because we don't know what's going to happen next. Things go wrong on a tariff argument, and 80-something% of the material that goes into automobiles in this country come from Canada and Mexico. What do you think happens to inflation, right? Then at the same time, you're laying off, I don't know how many government workers. We don't know what's going to happen, right? But what's been floated is there's going to be a huge cut to government workers. But what's been floated is that they'll have 2 years severance, 2 years pay to go find another job in the private sector. That's a lot of cost for people doing nothing. No joking now. No joking. I know you might say they're doing nothing in government now. But seriously, a lot of cost, no revenue coming in. And on top of that, we're going to cut tax, which is, basically what's used to service government debt. Taxes come in and you pay, government pays debt, right? So austerity, cutting taxes, and tariffs make for a nasty brew of uncertainty. And the bond players aren't having it anymore. And equity follows debt. Debt leads equity. So go look at this chart. This is, I mean, there are so many highlighted charts of the day. It was very hard for me to choose which one. This is the one I went with, okay? This is the high yield debt market. And I've been saying to you for a while, I don't get it. I don't know how treasury bonds can be doing this, which, by the way, 30-year bonds are down another 1% this morning, okay? So we broke below the lows in here, and it's going to gap down again this morning. And I've been saying to you for a while, how's it possible that long-term government bonds are imploding and high-yield corporate debt, no problem? Well, here's the problem. The symmetry of that breakdown yesterday from the breakout back in November last year, last year. And the breakdown is just phenomenal. Credit leads equity. At the moment, they're all running in unison. So again, I was willing to carry some risk. We raised 30% cash going into the Fed meeting yesterday. We raised 30% cash because of these concerns. I said to you, I'm whistling past the graveyard, but there's a lot of things going on that's completely uncomfortable to me. So let's raise some cash before the Fed meeting. Then we saw the reaction to the Fed news, crushed the S&P down to the key location of 600, which was the put wall, which happened to also be 3 standard deviations below the armor moving average. And I put on a small carry trade down there. I said, hey, it's now or never. It's either going to hold this put wall and bounce, there's going to be an epic long opportunity, or we've got a problem. I think I put that trade on at like 220. And by 245, not only was I out of that trade, I was dumping everything in my portfolios and sharing that with you. I was gone by 3 o'clock, maybe even sooner. I mean, I was just running through every portfolio, banging everything out. We'll go over, there's 2 positions in my off the record portfolio. One is still in Armor Innovative Growth off the record, whatever you want to call it. I cut it down to minimum position. I'll go over that in a minute. Everything else gone. All of our macro fund cash. Armor Invest we'll get to in a minute. Okay, so we knew coming in that we were whistling past the graveyard, and that got us prepared, and I hope it prepared you, to deal with what happened yesterday and not be a deer in the headlights, but just execute. We knew what was happening. We were whistling, and when the whistling turns to screaming, we're gone. Everybody else is still staring at the screen trying to figure out what's happening. We're gone. Risk monitors red, 10 indexes telling us to get out of the market. It's beautiful. It was a nice 2024. Whatever money you made, you made. It's a gift now. Forget about the gift of a Santa Claus rally. The gift you got is you got time off between now and the end of the year. The risk monitor's red, and there would be, I'm going to go out on a limb now and say absolutely nothing the market can do between now and the end of the year that would get the risk monitor green. When you look at this, when you look at the rogues gallery of the risk monitor, this is the Dow, total implosion. IBD 50, breaking below all the stops. Small cap, collapse. And just a quick note here, small cap collapse, and Amar Algo told us to get out of small caps here, okay? This was us getting out of small caps, right here. This was the location for us to get out of small caps. Even before it, so sometimes we use the 50-day moving average, sometimes the 25, and the algo told us get out of Dodge immediately. Small caps collapsing. Here's mid caps, which are not part of the 10 indexes, but I watched them just to get an idea of what's going on in the mid caps collapsing. Momentum collapsing. Equally weighted NASDAQ imploding. Equally weighted S&P already in trouble. Total collapse. Treasuries imploding down again today. And of course, value is just a disaster. So the two, the atlas that shrugged yesterday was the NASDAQ 100, which, believe it or not, is still above the 50, but broke down below the stop of the 25-day, and so that trades over. The stop was raised in this case. It's the strongest index. As you can see, everyone's hiding in the top 8 names. And then, of course, the equally weighted S&P just crushed through all the stops, okay? So nothing's going to happen that would change the risk monitor between now and the end of the year. When you get an ass kicking like that, it takes weeks, could be months, to set up another pattern where all the indexes are telling us to get long the market. Could be just weeks. Sometimes you go into a pretty nasty market and it can last a couple months. So congratulations. You had a good year. You made money. Don't look at, well, my net worth was higher yesterday. You're always going to give back something off the top, and take the opportunity now to spend some time with family. Trade. I'm going to be trading the indexes. The volatility spikes. There should be a lot of fun carry trades out there. So I'll be doing that every day till the end of the year. But basically, working on the whiteboard, getting myself ready for the next go round. And I know that that's not anytime soon. And hey, let me tell you something else. I just, I continue to be amazed at the strategy that we're running here, which is the Armor Swing strategy for triple the S&P. That strategy booked a profit on the 9th. We bought it on the 22nd. We had a 10-day rally and booked a profit. That strategy goes out at the high of the year. It gives back nothing. It avoids the total collapse in the market yesterday. New Year's resolution for me, I'm running a lot more money following that strategy in 2000. So to wrap up my thoughts, if you have any questions one-on-one, you want to try to help kind of need a sounding board to deal with how you're managing your assets, I'm happy to be a sounding board for you. So feel free to reach out. You can direct message me in Slack. Give me a call if you want, 561-575-6832. I'm here to help. Everybody have a wonderful trading day. And remember, make your own decision and be the smart money.